Well, we will see if anything exciting here happens on this investors call. Lots of bombs been dropping lately with Warner, HBO Max, lots of misinformation. Curious if we're going to hear anything about the Flash during this. I'm so glad they decided to just put this elevator music on loop during the wait period. It's fantastic. What's going on, chat? What are you guys excited to see here? What do you want to get some information on? They're supposed to be setting the record straight on what their streaming service goals are, so we'll see if we get any good insight into that. Wonder if any other, I don't know, major properties like Batgirl or anything like that's going to get canceled. Maybe we'll get confirmation as to whether Blue Beetle is still going to stay and get released in general, right? Really curious if they're going to touch on anything with the Flash. AEW wrestling canceled? I don't know. I haven't followed wrestling in years. I don't know. Is AEW not good right now? I know WWE has a big thing going on with Vince McMahon getting pretty much forced out. Big controversy there. You know what, King Kino, I am. It's been going pretty good. Hope the same for you. Since you want AEW to be canceled, I hope they cancel it. Wouldn't affect me any. One minute, let's see if they're punctual. They ought to be, since I'm sure a lot of their shareholders are kind of concerned. Kevin, I'm sure they will. If anything, I'm sure HBO is for 100% going to stay separate, and if anything, Discovery will be merged into HBO Max, I imagine. They could keep it separate just to have a Discovery anyway, separate for just to get it at a cheaper cost. I think even right now it's only like $5 to get Discovery. But HBO is just too unanimously known. They wouldn't get rid of that. What they should have done was not named it HBO Max to begin with. It was too confusing. And HBO, HBO Go, HBO Now, and then came out with HBO Max. It was just, no one knew what the hell was going on.
Good afternoon, ladies and gentlemen. Thank you for standing by, and welcome to the Warner Brothers Discovery second quarter 2022 earnings conference call. At this time, all lines are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. Additionally, please be advised that today's conference call is being recorded. I would like to hand the conference over to Mr. Andrew Slabin, Executive Vice President, Global Investor Strategy. Sir, you may now begin.
Good afternoon and welcome to Warner Brothers Discovery's Q2 earnings call. With me today is David Zaslav, President and CEO, Gunnar Wiedenfels, our CFO, and JB Perrette, CEO and President, Global Streaming and Games. Before we start, I'd like to remind you that today's conference call will include forward-looking statements that we make pursuant to the Safe Harbor provisions of the Private Securities Litigation Reform Act of 1995. The forward-looking statements include comments regarding the company's future business plans, prospects, and financial performance. These statements are made based on management's current knowledge and assumptions about future events and involve risks and uncertainties that could cause actual results to differ materially from our expectations. In providing projections and other forward-looking statements, the company disclaims any intent or obligation to update them. For additional information on important factors that could affect these expectations, please see our Form 10-K for the year ended December 31st, 2021, our quarterly report on Form 10-Q for the quarter ended March 31st, 2022, filed with the U.S. Securities and Exchange Commission on April 26, 2022.
Now, if you guys don't know, a lot of these calls can be very boring for a while, so just be prepared. We might not get any useful or exciting information for a while. It's going to be a lot of legal jargon and just financial numbers, but nevertheless.
This release is available on our website at ir.wbd.com. We released a trending schedule with pro forma results and additional financial information, which also can be found on our website. And lastly, our discussion today will include an accompanying
Carlos, we won't know the
TLDR
TLDR until the end.
Will be available on our website. And with that, let me turn the call over to David.
Hello, everyone, and thank you for joining us. We've had a very busy and productive 4 months since launching Warner Brothers Discovery, and today we want to provide you with an update on where we are and where we're headed. Among our top priorities have been combining the rich legacies of these two great organizations, building out our senior management team, and beginning to integrate the cultures into one global operating company. We've made significant progress on all fronts. Nearly our entire senior leadership team is in place, and I could not be more excited to continue locking arms with the exceptionally talented group of individuals that we've assembled from both legacy companies. Plus more recent additions like esteemed filmmakers Mike DeLuca and Pam Abdi, now at the helm of Warner Brothers Pictures Group, and a uniquely talented media operator, Luis Silberwasser, driving our leading global sports strategy. And just last week, we announced our new Chief of Diversity, Equity, and Inclusion, Asaf Sadiq. Asaf previously served as Head of Diversity, Equity, and Inclusion International for Warner Media and is one of the most dynamic leaders in the diversity space. Since the close of the deal, the entire leadership team has been moving as quickly as possible to integrate key elements of our business, assess growth opportunities, and make important progress in our synergy capture and strategic planning. We've been able to dig deeper into the financials and have gained a much better, more complete picture of where we are and the path forward, including identifying some additional and unexpected challenges that have and will continue to require our focus and attention. The upside is that there is even more room for improvement and cost savings. At the same time, we're keeping a close eye on the many cross-currents and headwinds at play in the macroeconomic environment, both here in the U.S. and globally, including inflation, the threat of recession, and the complexities of today's geopolitical environment. In light of all these factors, we've had to make some additional adjustments, which we'll talk about.
Future of
Gunnar will
HBO,
walk you through
future
our
of
financials
DC.
and the path forward in a few moments. Suffice to say, we are more confident than ever in the strength of our position and believe we are on the right path to meet our strategic goals and really excel, both creatively and financially. Our long-term investment thesis is truly compelling, and we have great conviction in the opportunity ahead. Warner Brothers Discovery has the most powerful creative engine and bouquet of owned content in the world, as highlighted by our recent 193 Emmy nominations, more than any other media company. The fact is, there are only a handful of companies globally that can do what we do. And putting it all together, we believe no one does it better than us. Spanning HBO, Warner Brothers Film and Television Studios, CNN, our world-class sports business, and category-defining lifestyle and nonfiction content engines. Our asset mix, one of the most complete and diversified in the industry, uniquely positions us to drive a balanced approach to creating long-term value for shareholders. It represents the full entertainment ecosystem and an ability
no
to
more
serve
scripted content on
across
HBO.
the entire spectrum of offerings, from premium pay to linear and free-to-air, theatrical to streaming. This was the driving force to create this company over a year ago. Our objective was not only to be one of the top global streaming companies,
no problem,
but also a media
Alexandria.
company
Hopefully we
able
get
to
some good
drive
info.
financial returns by distributing our content on every platform. And our conviction has not changed. While we're still in the very early stages and helped by the first wave of our synergy initiatives,
That's the second
we will have
cancel
repaid
AEW
$6
so
billion
far.
in debt by the end of August. And we have implemented initiatives leading to $1 billion in run rate synergy over the next 12 months, with at least an additional $2 billion in the works as part of our cost synergy plan. We did very well at the upfront and believe we have meaningfully outperformed our peers. As I said at our presentation, we see ourselves as essentially the fifth broadcast network due to our unparalleled portfolio. And our low to mid-teen CPM increases on nearly $6 billion in commitments clearly demonstrates that advertisers now view us exactly that way. We offer our partners the most complete portfolio of live sports and news, lifestyle and entertainment, and our average share of viewership outside of the football season exceeds 25%. On some nights, we're bigger than NBC, ABC, CBS, and Fox combined. While there's a lot of uncertainty in the economic backdrop, this is a strong proof point for the value we bring to the table and our ability to improve monetization over time. In many ways, we're just getting started and have really only begun to scratch the surface with respect to the potential upside, and believe we'll make even more headway in the next 2 to 3 years. At every stage of this endeavor, as we pursue opportunities and tackle challenges, build and grow our business, we will be guided by 3 strategic priorities that will inform all of our planning and decision-making. First, we will seek to attract the best storytellers and use our unparalleled creative engine, franchises, and brands to produce the most compelling and diverse content offering in the world. We are home to many of the most iconic brands and franchises in the history of entertainment. Batman, Superman, Wonder Woman, Harry Potter, Looney Tunes, Hanna-Barbera, Game of Thrones, CNN, HBO, HGTV, Discovery, Warner Brothers Pictures, Warner Brothers Television, and many, many more. The opportunity this presents is truly unmatched. We're also the preeminent maker and seller of content in the world, and going forward, we will continue to invest smartly in content in ways that will help us to grow, achieve greater market share, and have a bigger impact. Some of the content we create will be distributed on our platforms, like the highly anticipated House of the Dragon, premiering on HBO Max later this month. And some will air on other platforms, such as Ted Lasso and Abbott Elementary. Our focus is on making great content that people want to watch and will pay for. As I've said, it's not about how much, it's about how good. Owning the content that really resonates with people is much more important than just having lots of content. In other words, at a time when almost every piece of content ever made is available to consumers across any number of free and paid services, curation, quality, and brands have never been more important. And that is what we do best. When the measure is who's got the best stuff, no one has a better hand than we do. Second, we will maximize the reach, engagement, and overall value of our content through a broad distribution and monetization strategy. Our job is to tell great stories and to bring them to as wide-ranging an audience as possible, in as many ways as possible, and to deliver the greatest viewing experience possible. Certainly, technology plays a big role in this, and we still have a lot to learn. But it's equally important that we be flexible and agile, able to respond to ever-changing consumer preferences. As the maker and owner of the largest and most complete library of content in the world, we cover more surface area than almost any other media company. Theatrical, streaming, linear, cable, free-to-air, gaming, consumer products and experiences, our own platforms, others' platforms. And we have no intention of being beholden to any one in particular or to a specific business model. Simply put, we are open for business. There's been a lot of experimentation in our industry, and we are all smarter for it. At Warner Brothers Discovery, we believe strongly in the importance of preserving optionality and driving returns through a strategic mix of distribution and windowing options. For example, we will fully embrace theatrical, as we believe it creates interest and demand, provides a great marketing tailwind, and generates word-of-mouth buzz as films transition to streaming and beyond. When you're in theaters, the value of the content and the overall viewing experience is elevated. Then when the same content moves to PVOD and then streaming, it is elevated again. As films move from one window to the next, their overall value is elevated, elevated, elevated. We saw this clearly demonstrated with The Batman and Elvis. We have a different view on the wisdom of releasing direct-to-streaming films, and we have taken some aggressive steps to course-correct the previous strategy. With respect to streaming, our main priority right now is launching an integrated SVOD service. And in a few moments, JB will talk more about the strategy and some of the key building blocks and milestones as we bring HBO Max and Discovery Plus together under one offering. Our streaming strategy has evolved over the past year and really reflects the importance of, rather than the dependence on, this segment of our global content monetization plans. I am pleased with the work to date and the progress we continue to make on this front. And in the spirit of optimization, once our SVOD service is firmly established in the market, we see real potential and are exploring the opportunity for a fast or free ad-supported streaming offering that would give consumers who do not want to pay a subscription fee access to great library content, while at the same time serving as an entry point to our premium service. We will talk to you more about our potential plans at our Investor Day, which is planned for the end of the year. I'm also pleased to announce today that we have extended our relationship with AT&T, making them a trusted partner in the distribution of HBO Max as part of their service offerings. This is great news for our business as it ensures that even more people will have access to our world-class and award-winning content. This leads to our third strategic priority, and that is to operate as one company with one mission, to be the premier media and entertainment leader globally. We believe the best way to maximize the value of our company is by operating our businesses as a combined enterprise rather than as a series of separate, siloed, and unconnected business units. HBO, Warner Brothers Pictures, Warner Brothers Television, CNN, our U.S. networks, sports, we are stronger together, and we're making meaningful progress in operating our businesses as one team. We also have a great ability to promote, advertise, and introduce new products and services enterprise-wide. And we intend to take full advantage of these capabilities. You saw this with the successful rollout of Elvis across all of our platforms. and you're seeing it now ahead of the launch of House of the Dragon. We're employing every capability at our disposal. It is the biggest campaign in HBO's history, and it's already paying dividends. Rewatching of the original Game of Thrones is up dramatically on HBO Max. We're also going to be opportunistic about the way we grow our business in the future, whether by improving existing products or services to enhance and personalize the consumer experience, introducing new ones, or expanding into new markets globally, with particular focus on how to scale smartly, with an eye on sustainable free cash flow, even during periods of incremental reinvestment. We see ample opportunity to drive significant efficiencies from further integration and transformation, which Gunnar will take you through. It's a foundational tenet of how we will operate and manage, the byproduct of which will be significant free cash flow generation and growth. So, our three strategic priorities are to create the most compelling and diverse content offering in the world, maximize its reach, engagement, and value through a broad distribution and monetization strategy, and operate as one company with one mission to be the premier media and entertainment leader globally. In an industry as dynamic as ours, we are best positioned for success. We have everything we need to thrive, creatively and financially, including the greatest and most popular franchises and IP, the most diverse collection of global media brands and assets, the ability to generate awareness and excitement for our products across our own various platforms, a strong leadership team, and the most talented creatives. While we're still in the early innings, I couldn't be more excited about where we're headed as a company. As I said, we're open for business. And if you're in this business, this is the place to be. We look forward to sharing lots more with you at our Investor Day at the end of the year. And with that, I'll turn it over to JB, and he'll walk you through the details of our SVOD strategy.
Thank you, David. And hello, everyone. Over the last almost 120 days, I've had a chance to spend time with this incredibly talented team, take a closer look at both products and their technology, better understand our proficiencies, as well as areas where there's need for further development, and dig in on what consumers are saying about the two services. We have a lot of work to do, but these first few months have only strengthened our belief in the significant opportunity ahead of us. And I'm excited to share with you some initial thoughts on our strategy and roadmap. First, a bit of context. For decades, our industry has embraced changing technology and consumer demand by evolving the very successful windowing approach to exploiting content. However, in recent years, a strategy has emerged that suggests the video business will be better off collapsing all windows into streaming, overpaying for and overinvesting in content, and offering it all at the same time for a low price. We don't believe in this strategy. While we intend for streaming to be a critical part of our company and a key driver of our growth as consumers continue to shift their viewing habits from linear to nonlinear, it's only one part of our diversified approach. The focus of our streaming strategy is consumer choice. We believe there are multiple global consumer segments in streaming, just like there have been for decades in traditional television. Some who are willing to pay a premium for an ad-free experience, others who are more price conscious and prefer to pay less with limited advertising, and a sizable third group who will not pay a subscription fee and only want to enjoy ad-supported entertainment. Warner Brothers Discovery's unmatched depth and breadth of content provides us the opportunity to offer something for everyone. Providing consumers with a range of entertainment options will maximize our reach and financial returns. Currently, we're focused on launching our combined SVOD product with both an ad-light and an ad-free version in many markets. But, as you heard, we've also begun to explore options of how best to reach consumers in the free ad-supported streaming space. We currently license our library to others, but we'll assess how best to play in this growing business as the model evolves from free-to-air linear to free-to-view streaming. Now, focusing on our ad-free and ad-light SVOD offering. The great news is the combination of HBO Max and Discovery Plus could not come at a better time, as both are enjoying strong momentum. HBO Max has emerged as the most acclaimed streaming service among consumers, and Discovery Plus remains one of the top-rated apps and the dominant leader in real-life entertainment. They are also two very unique and complementary streaming services, distinct in their content appeal, ranging from premium scripted series like Succession and the much-anticipated House of the Dragon, to leading unscripted programming such as 90 Day Fiancé and Fixer Upper. The two services are also different in terms of how subscribers engage with the content, some of it being more appointment viewing, driving subscriber acquisition, other content being more comfort viewing, driving subscriber retention, with people watching hours on end. These are two critical and powerful components of a strong and sustainable subscription business. Couple this with our world-class collection of globally recognized brands, franchises, series, and characters. It is truly an unprecedented combination. In an already crowded market, consumers know these brands and they trust them to deliver quality. The quality of our content engine speaks for itself, as evidenced by the 193 Emmy nominations this year, more than any other media company. From drama to comedy, documentaries to factual, lifestyle to reality, local series from around the world to sports in Europe and Latin America, and of course, movies. Ahead of the launch of our new combined service, we're introducing a number of exciting interim initiatives. First, content sharing. As we announced earlier today, Discovery Plus will add a CNN Originals hub on August 19th, making it the home of the award-winning CNN series and films, including the Anthony Bourdain collection, and featuring series such as This Is Life with Lisa Ling and Stanley Tucci, Searching for Italy. And starting later this fall, HBO Max will begin hosting some of the Magnolia content from the incomparable Joanna and Chip Gaines, including their latest series, Fixer Upper, The Castle, arriving in October. Second, as David mentioned, we are leveraging the marketing power of our combined portfolio. With the biggest TV audience many nights in the US, the second largest broadcast group in Europe, the number one pay TV portfolio in LATAM, and leading pay TV lineup in APAC. We will drive significant awareness for our content and streaming products, much at no cost given the creative use of unsold or non-commercial inventory. Shark Week is just one recent example of the marketing benefits and financial synergies we see from strategic cross-promotion across our company. Now, more about the product and technology. We will roll out our new combined offering under a single brand, and we'll have more to share closer to launch. On the product side, we recognize that both of our existing products have shortcomings. HBO Max has a competitive feature set, but has had performance and customer issues. Discovery Plus has best-in-class performance and consumer ratings, but more limited features. Our combined service will focus on delivering the best of both, market-leading features with world-class performance. To deliver this, our team has developed a clear roadmap to migrate onto one tech stack, leveraging much of the core infrastructure of the highly rated Discovery Plus service, with significant and important feature enhancements from the more established HBO Max. Our product design and feature set will enable better content discovery and more personalized choices. All this, coupled with the unparalleled breadth of quality content, will help drive our leading objective, which is growing engagement. This will in turn enable us to meaningfully reduce churn, support gross ads, and increase monetization, particularly with our ad-light offering. There's much work to be done over the coming months, from retooling the tech platform to enabling proper content and metadata ingest around the world, and ensuring a seamless customer migration for launch. There's lots to do, and we're determined to get it right, which will take a bit of time. Our primary focus for the rollout will be in the markets where HBO Max is already launched, given its broader international footprint. We plan to launch the service sequentially starting in the US next summer. Latin America will follow later in the year. European markets with HBO Max will follow in early 24, with additional launches in key Asia-Pacific territories and some new European markets coming later in 2024. Of course, as we get more of the development work and testing under our belt, we will explore ways to accelerate the rollout if and where it makes sense. In addition, there will still be significant opportunity for expansion beyond this, as these 70-plus countries represent less than 60% of broadband homes globally, excluding Russia and China. And many of the biggest markets, such as the UK, Germany, and Italy, do not fall within this 2025 plan. But we want to remain disciplined and prove out the strength of our product and profitability first. All this culminates in developing a strong, financially attractive business over the next 3 years. Our focus is on shaping a real business with significant global ambition, but not one that solely chases subscribers at any cost or blindly seeks to win the content spending wars. Instead, one that scales smartly. So now, what does this all mean for the streaming business? Our financial North Star will be EBITDA, driven by solid top-line growth and greater cost efficiency from the combination of these two products. We expect peak EBITDA losses for the D2C segment will occur this year in 2022 as we do the heavy lifting around technology, personnel, and integration ahead of the planned relaunch starting next summer. We're targeting the U.S. streaming business to be profitable in 2024 and for the global streaming segment to generate $1 billion in EBITDA by 2025. Embedded within this target result for 2025 is an EBITDA drag from less mature markets and new market launches. We believe that we can achieve these milestones with a total subscriber base of around 130 million global subs. Today, our total subscriber number for HBO Max and Discovery Plus is 92 million, an increase of 1.7 million over first quarter. This number now excludes other streaming products in the portfolio and synchronizes our subscriber definitions, which Gunnar will get into more later. The goal of this is to provide you with a clear and transparent number of true paying subscribers to our core service. You should also note that we estimate an additional overlap of around 4 million subscribers between the two services today. So we anticipate adding more than 40 million incremental subs by 2025. Turning to ARPU. As we just reported, our current ARPU is almost $8 globally, comprised of nearly $11 domestically and almost $4 internationally. We expect healthy ARPU growth off this base due to a few factors. First, a new pricing strategy. Consistent with our profitability focus, we will shift away from heavily discounted promotions that were part of the gross ads focused strategy of the past to a more balanced approach that optimizes revenue as well as subscribers. Second, and related to this, price increases, particularly in certain international regions where we are well below market. We will also plan for periodic increases as accepted in the marketplace. Third, scale benefits from broader distribution of our ad-light offering, and as our reach and engagement grow, we will also drive CPMs, leveraging technology-enhanced products and targeted advertising. We've clearly started seeing the benefits of this at Discovery Plus. On the cost side, we see meaningful synergies from two particular non-content areas. Marketing, which is over 60% of SG&A, will see benefits by moving to a single branded product, leveraging the power of our owned networks, as well as more optimized spend. And technology, which is the third largest portion of our OpEx, where we will eliminate duplicative spend, reduce third-party vendors, and see significant opportunities for automation. Looking ahead, we will continue to have healthy content investment, though with these two content portfolios coming together, we see smart opportunities to do this at a much more measured pace than in the previous plans. All in, we see long-term margin potential at scale of at least 20% and expect to make significant progress towards that goal over the next few years. Lastly, based on the operating leverage in the business, we believe we can achieve incremental margins of around 50% of every dollar of additional revenue growth. To summarize, at Warner Bros. Discovery, we believe that in an already crowded market and at a time when the global economy is prompting many consumers to prioritize their purchase decisions, we are uniquely and best positioned to be at the top of global consumers' lists for video entertainment. Our greatest strength and what positions us for success as a company long-term is our ability to monetize our unparalleled collection of content in multiple ways in order to provide consumers choice and optimize asset value. That is what we intend to do, and streaming will be one key part of our overall strategy. We look forward to sharing more with you as we get closer to launch, and now I'll turn it over to Gunnar for a closer look at our Q2 financials.
Thank you, JB, and good afternoon, everyone. As you heard from JB, we are taking a thoughtful approach in how we intend to scale our D2C business, smartly and methodically, and as just one component of a more balanced distribution strategy versus one that seeks to drive subscriber growth at any cost. This will be an important theme throughout the discussion of our second quarter financials and our outlook for the balance of the year as well as 2023. Turning to our financials, as you can see, it's been an extremely busy first full quarter as a combined company, strategically, operationally, and financially. Picking up from when we spoke to you last, while we've already implemented a significant number of initiatives following the closing of the WarnerMedia transaction, we've only become more confident about the long-term potential for Warner Bros. Discovery. The strategic logic behind bringing these two great companies together is as apparent and sound as when we announced the deal. As noted prior, the recently concluded upfront is a timely example of just that. Despite the more challenging macro environment, we're very pleased with our performance, which proved the enormous value of our content portfolio to our advertising clients and as a differentiated means to service brands. Out of the gate as a combined company, we have been focused on debt paydown, and I am pleased to report that by the end of this month, we will have paid down $6 billion of debt since closing the transaction. We're equally as focused on integration and efficiency, and I'm very pleased with the progress of the synergy program. We now have 1,000 individual initiatives staffed, measures already implemented worth $1 billion of run rate savings, a clear grip on milestones and business cases for at least another $2 billion in flight, and eyes on further upside and opportunities. We will continue to update the market on progress as well as implications for related costs to achieve as we move our synergy program through the implementation stages. Now I'd like to very briefly address our Q2 results, which we are providing in a new segment structure. The composition of our new segments is very similar to the way Time Warner presented previously. In addition to the second quarter financials, we also provided trending schedules, including 2021 segmented pro forma financials with the earnings release this afternoon, to give you a financial baseline for Warner Bros. Discovery. The trending schedules are also available on our investor relations website. I will speak to the second quarter financials on a reported basis and will address growth rates on a pro forma combined ex-FX basis as always to provide more transparency on underlying performance. Let's turn to the individual segments, starting with Studios. Studios results were driven by strong games performance, specifically behind LEGO Star Wars: The Skywalker Saga, as well as consumer products, while home entertainment and theatrical faced difficult comparisons against last year's strong COVID-lifted catalog sales and larger film slate. Within networks, revenue was up 1% and EBITDA was down 11%. Advertising increased 2% globally, largely driven by sports on the Turner Nets in the US, while international advertising was down modestly, in large part due to the sale of Chilevisión last September, as well as a decline in EMEA. Global distribution revenue was down slightly, with the US flattish and international down 3%, which was impacted by pricing declines in Western Europe. EBITDA decreased in part due to increased sports rights costs versus last year. Within D2C, revenues increased by 4%, while adjusted EBITDA declined $325 million year over year. Performance was mainly driven by, number one, substantial content investments across the global footprint as part of the push to launch HBO Max in as many markets as possible prior to closing the deal, as well as, number two, revenue pressures in the wake of sunsetting the Amazon distribution deal last September, and number three, tough prior year comps with 2021 enjoying the benefit of the day-and-date windowing strategy for Warner Brothers feature films. Consistent with our prior comments, we continue to thoughtfully spend ahead of the launch of our integrated product, in part having put some planned new country launches on the back burner, but we are gearing up and are very excited for the global release of House of the Dragon in August, the highly anticipated prequel to Game of Thrones. Importantly, we're changing the way we present our D2C subscriber numbers going forward to align our subscriber definitions across the legacy Discovery and Warner Media businesses. Starting with the paying subscriber count reported on our Q1 earnings call of roughly 100 million subscribers, we have made the following key adjustments that total 10 million subscribers. First, the HBO Max subscriber number historically included certain unactivated subscribers under the AT&T Mobility distribution agreement. Consistent with legacy Discovery policy, we will exclude such unactivated subscribers going forward. Second, as JB detailed, we have refined our strategy with a clear focus on one combined D2C product. As such, going forward, we will exclude non-core D2C subscribers outside of the Discovery Plus or HBO Max products from our account, such as subscribers of MotorTrend, Eurosport Player, and a few smaller other products. Against this harmonized definition, we ended Q2 with 92.1 million subscribers, representing 1.7 million sequential net adds during the quarter. Please refer to the aforementioned trending schedules for historical subscriber data as per the harmonized definition. Please note that while we have adjusted our ARPU calculations for the corresponding revenues, total Warner Brothers Discovery D2C segment revenue will still include fees received from and for those subscribers no longer included in our core subscriber count. Now turning to the consolidated group. On a consolidated basis, revenue was down 1%, driven by increased intercompany eliminations, impacted by larger internal sales and licensing, while adjusted EBITDA was down 31%, or $812 million year over year. These results are driven by the legacy Warner Media businesses, with significant cost increases across all segments. Please note, year on year, FX was a $228 million headwind to revenues and a $30 million headwind to adjusted EBITDA during the quarter. Despite the many cross-currents running through our P&L at the moment, we ended the second quarter with $789 million of reported free cash flow. This included approximately $250 million of cash restructuring and one-time charges related to the merger and integration. With respect to overall Q2 financial performance, clearly these results are neither indicative of the health of the underlying assets nor of their longer-term trajectory, but rather the fact that we're starting from a less favorable position compared to our expectations. In addition to the clearly more challenging macroeconomic backdrop and a changing industry dynamic in the streaming space, we have also now had an opportunity to fully assess legacy Warner Media's financials post-closing. Having concluded this process, we determined that certain legacy Warner Media budget projections that were made available to us prior to closing varied from what we now view as legacy Warner Media's budget baseline post-closing. On taking a deep dive and pressure testing what we found, our assessment has resulted in lower EBITDA projections. Specifically, we identified a number of approved investments and foregone revenue in various parts of the business that, when taken together, impacted full year 2022 EBITDA by roughly $2 billion. Some examples of these business decisions include, number one, significant reductions in external content sales. As part of a corporate initiative to prioritize HBO Max growth globally, new content licensing deals to third parties were largely halted, and content was, in general, made exclusive to HBO Max. This is, of course, an upside opportunity over time as we ramp initiatives back to a balanced level of monetization depending on relative value contributions. Number two, similarly, certain actions taken to limit HBO Max's B2B distribution provided a headwind to performance, and we believe there may be opportunities to course correct. Number three, substantial investments in kids and animation content for both linear and D2C platforms without an adequate investment case against them. Number 4, substantial investments in direct-to-HBO Max films, for which, again, we did not find sufficient support. This means adjusting the way we invest going forward and also evaluating those projects already completed or in progress. Wonder Twins, Batgirl, and Scoob Holiday Haunt are examples of streaming films that do not fit this new strategic approach. These are difficult decisions, but we are committed to being disciplined about a framework that guides our content investment for maximum returns. Number 5, significant incremental and loss-making content investments for the Turner networks, specifically content spent on shows that did not have a path to generate sufficient ratings or incremental monetization potential. And number 6, incremental corporate expenses transferred from AT&T resulting from the spin-off of Warner Media as per the final carve-out financials. While these factors will of course impact our 2022 financial performance and 2023 to a lesser extent, we have implemented immediate measures to address and redirect the trend line. Most importantly, supported by key leadership changes and the introduction of a more robust framework for capital allocation based on financial metrics and measured KPIs. Key measures include, number 1, the shutdown of CNN+. Number 2, restructuring the scripted content portfolio on the linear nets, kids and animation, direct to HBO Max films, as well as international local content not sufficiently supported by robust enough investment cases. Number 3, a more balanced approach to external licensing as we embrace a more holistic content monetization model for Warner Bros. Discovery globally, generating significant revenue upside while protecting key strategic franchises such as Friends, Big Bang Theory, Game of Thrones, etc. Number 4, implementing an HBO Max distribution strategy aimed at wide availability as opposed to D2C only distribution, as well as number 5, greater accountability, alignment, and communication across businesses. Turning now to synergies. Our work on integration and transformation since closing gives us increased confidence in the synergy opportunity. Every day over the past 15 weeks, I have experienced the muscle memory that many on our integration teams have built over the past years of change and integration. We have already implemented initiatives totaling more than $1 billion of run rate impact. This will grow from this point. The opportunity to implement transformational change across the global organization is enormous, and we're being thoughtful about its prioritization and cadence. Individual initiatives range from direct merger-related opportunities, such as consolidating our real estate footprint against hybrid and agile work environments, to opportunities tied to David's operating philosophy as one integrated company. The latter opens up tremendous transformation potential along systems integration, process harmonization, and importantly, optimized utilization of our O&O promotion and advertising potential. I am very pleased with how well the program has progressed so far, and based on the savings potential in our initiative funnel, I have full confidence that we will extract at least $3 billion of synergies overall, with $2 to $3 billion of synergy realization in 2023. Naturally, we'll update the market regularly as certainty on value and timing increases. With that, I want to share our current thinking on the 2022 and 2023 financial outlook. As you may recall, we first developed our guidance for the combined Warner Bros. Discovery 15 months ago. Today, after 100 days of thorough analysis and financial planning post-close, we are adjusting our 2022 and 2023 EBITDA outlook, primarily based on, first, a less favorable macroeconomic backdrop, resulting in a more conservative outlook overall and for ad sales specifically. Second, a change in the streaming industry dynamics and our strategic response. And third, as noted earlier, the differences in legacy Warner Media budget projections that were made available to us prior to closing versus what we now view as legacy Warner Media's budget baseline post-closing. Taking all these factors into account, 2022 will clearly be a transition year, and we see an adjusted EBITDA in a range of $9 to $9.5 billion. For further context, I'd like to provide some color on third quarter trends. Global advertising revenues in the third quarter will be impacted by some tough prior year comps, specifically the Summer Olympic Games, 2 NBA Eastern Conference Finals games played in early July last year, as well as the sale of Chilevisión. And given the less favorable macro environment, we are seeing softer demands in the scatter market at the moment. As such, We expect Q3 global ad sales to decline by high single to low double digits based on current booking trends. On the positive side, we are beginning to see the impact of our course-correcting measures, and we expect some synergy capture beginning in the back half of this year. Furthermore, we expect to generate free cash flow of around $3 billion after cash cost to achieve in 2022. On that basis, I am expecting net leverage at year-end to be approximately 4.8 times. Turning to our outlook for 2023, based on the full year impact of our 2022 corrective actions and $2 to $3 billion of synergy realization in 2023, we expect adjusted EBITDA to be at least $12 billion. We expect to convert approximately a third to a half of our adjusted EBITDA into free cash flow in 2023 as we make progress towards our long-term target of approximately 60%. The cadence of content investments, restructuring spend, CapEx, and working capital improvements will impact the timing of free cash flow generation. With that, I want to give a quick snapshot on our balance sheet. We are reiterating our long-term gross leverage target of 2.5 to 3 times, which we expect to hit by the end of 2024, and our gross leverage will be within our current ratings category by mid-2024 or earlier. As stated before, we will continue to dedicate virtually all free cash flow generated to debt reduction until then. We had $53 billion of total debt at the end of Q2, including $6.5 billion of term loans. Importantly, our debt financing is generally long-term, with an average maturity of more than 14 years and a 4.3% average interest rate, and equally importantly, interest rates for the vast majority of our debt are fixed. We have no remaining payments due in 2022, and we currently have $1.3 billion due in 2023 and $4.3 billion due in 2024. Also note, earlier this week, we finalized the post-closing working capital adjustment process with AT&T as part of the merger agreement. And as a result of that, AT&T will pay us $1.2 billion in August. With that, and combined with prepayments made in July, by the end of August, we will have paid down $6 billion since closing the transaction in April. We've covered a lot of ground today, though we've really only scratched the surface with respect to the significant amount of strategic work being done across the organization. And we'll take you through a much deeper dive with a comprehensive look across content and networks, as well as D2C, at our Analyst Day towards the end of the year. In closing, if there is one key message to take away, it is that we have never been more excited about the underlying strength of the creative bedrock of this combined company and the broad monetization opportunities for decades to come. David's leadership team has come together quickly, and we're fully focused on driving hard to deliver the value upside of this combination, and I remain excited to share our progress with you along the way. With that, I'd like to turn it over to the operator, and David, JB, and I will be happy to take your questions.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you would like to ask a question, please press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by the number 2. Please stand by for your first question. Your first question will come from Bryan Kraft at Deutsche Bank. Please go ahead.
Hi, good afternoon. Let's ask two if I could. I guess first, David, there's a lot of reporting in the press about film dates being delayed and, of course, the canceling of Batgirl. I think that film in particular was almost completed. Can you just talk about the reason for the decision to cancel Batgirl? And was it an issue? And what's happening more broadly, Warner Brothers film business, changes you might be making, and particularly the direction you're taking with the DC universe? And then just had one for JB on the FAST product. Is the intent there to offer the FAST service in Western markets like the U.S. where consumers are accustomed to paying for content, or will it be more limited to markets where you've got, where you would have a low penetration of paid services and therefore, a way of building penetration where you might not otherwise achieve it? Thank you.
Great. Thanks, Brian. Well, let me start with the fact that the Warner Brothers Motion Picture Group has fantastic IP and a great history, as you know, where they're turning 100. And between DC, the animation group, together with the entire Warner library, our ambition is to bring Warner back and to produce great high-quality films. And as we look at the opportunities that we have broadly, DC is one of the top of the list for us. You look at Batman, Superman, Wonder Woman, Aquaman. These are brands that are known everywhere in the world, and the ability to drive those all over the world with great story is a big opportunity for us. We have done a reset. We've restructured the business where we're going to focus, where there will be a team with a 10-year plan focusing just on DC. It's very similar to the structure that Alan Horn and Bob Iger put together very effectively with Kevin Feige at Disney. We think that we could build a long-term, much stronger, sustainable growth business out of DC. And as part of that, we're going to focus on quality. We're not going to release any film before it's ready. We're not going to release a film to make a quarter. We're not going to release a film the focus is going to be how do we make each of these films in general as good as possible. But DC is something that we think we could make better, and we're focused on it now. We have some great DC films coming up, Black Adam, Shazam, and Flash. And we're working on all of those. We're very excited about them. We've seen them. We think they're terrific, and we think we could make them even better. And that's what Mike and Pam and the team are doing and focusing on that. Strategically, we've looked hard at the direct-to-streaming business. We've seen, luckily, by having access now to all the data, how direct-to-streaming movies perform. And our conclusion is that expensive direct-to-streaming movies, in terms of how people are consuming them on the platform, how often people go there or buy it, or buy a service for it, and how it gets nourished over time, is no comparison to what happens when you launch a film in the motion picture, in the theaters. And so this idea of expensive films going direct to streaming, we cannot find an economic case for it. We can't find an economic value for it. And so we're making a strategic shift. As part of that, we've been out in the town talking about our commitment to the theatrical exhibition and the theatrical window. A number of movies will be launched with shorter windows. Some might have different kinds of marketing campaigns where we take advantage of us having the biggest platform and a platform that all motion picture companies look for. But we'll always be agile. Our focus will be on theatrical. And when we bring the theatrical films to HBO Max, we find they have substantially more value. And we have an ecosystem where we can have the premier motion picture business. That's why most people move to Hollywood. That's why most people got in this business, to be on the big screen when the lights went out, and that is the magic. And the economic model is much stronger. And the other thing is that we're going to focus very hard on quality. I said we're not going to launch a movie until it's ready. We're not going to launch a movie to make a quarter. And we are not going to release a movie, and we're not going to put a movie out unless we believe in it. And that's it. I mean, and particularly with DC, where we think we want to pivot and we want to elevate and we want to focus.
And Brian, on FAST, two quick comments. Number one is just a reminder that as we look at that space, the content we're talking about that would be in that kind of a product would be totally different than the content that would be in our premium SVOD offering. So number one, the distinction is totally different. And with over 100,000 titles or episodes across our combined portfolio, there's a lot of content that wouldn't necessarily make sense in a premium product that might make sense in a FAST. The second thing is on a market by market. Look, that's part of the assessment that we're looking at and we'll look through over the next few months. And as we have more details of how we think and where we think the opportunity is the richest, we'll come back to you and take you through it.
Just the objective is to grow the DC brand, to grow the DC characters, but also our job is to protect the DC brand, and that's what we're going to do.
Great, operator.
Thank
Let's head to the next question, please. Operator, next
That's
question,
important.
please.
Your next question comes from Jessica Reif Ehrlich of Bank of America Securities. Please go ahead.
Thank you. I hope you meant questions. So if it's okay, I'd actually like to go around to each one of the speakers. David, one thing, I mean, you have an amazing set of assets, but one thing that's clearly being challenged are your linear networks. And I think the big surprise in Q2 results so far is how bad the video sub losses are in the U.S. So can you just talk about your longer-term view of your linear networks? For JB, just on the content side, it sounds like sports news are going to be an important part of your content strategy. How different is that from linear? How are you thinking about getting new content for direct-to-consumer? And then Gunnar, just on the guidance. So if you take your 22 guidance of $9 to $9.5 billion plus the $2 to $3 billion, I guess, of synergy, we're at 11.5 or 12 billion for 23 as a base. But what about if DTC's direct-to-consumer losses are peaking this year and coming down? Can you give us color on the magnitude? Upfront, it sounds like pricing was great. Film should be normalized. Where do you see the underlying growth?
Well, why don't I start with the linear business? Because we're big believers in the linear business. There is some secular decline. There's been secular decline. It's leveled off. It's declined more. In the end, you look at March Madness, the biggest numbers since '94. The NBA up dramatically. That was at a time when people said nobody below a certain age is watching. Well, they're tuning in for sport. They're tuning in for news. And when you look at the overall portfolio that we have, live sport, live news, together with entertainment and the best kind of branded nonfiction library where people get up, the lovers of food, of HG, of ID, and watch all day. So we think, it's very hard to predict, but we expect it's going to be a very significant cash generator for us and a very good business for us for many, many years to come. We have a great team running it. This is what we do. It's what we know how to do. We have a team that's been doing this for 30 years. If the linear business is a race car, we got a team of race car drivers. And when we hear a noise or it's in third gear, we know how to fix it. It's a business we know well. We haven't begun to implement the libraries that we have now, where we could take content old documentaries on crime from HBO and put them on ID, or take programming that exists in the library and move them on each of the cable channels, or vice versa. So that hasn't begun yet. We also are first getting our hands around the idea that we are very often the largest player in America in terms of our reach, and the ability to use that now to tell people when they're watching hockey, you could come over now and watch Discovery, and if they're use our existing platforms to drive viewership from channel to channel. So I've been around a long time. Broadcast was dead when I was hanging out with Jack in the 90s. That was what people said. But in the end, that reach and the ability to drive advertising product is what kept it alive. We're still seeing CPM increases. We were in the low to mid-teens this time. We're big believers, and we think that's going to help us.
He is right about the docuseries stuff.
The great thing that we have is we're going to have both sides. We have this very compelling free cash flow driver around the world, domestically and around the world. And then we have the dual service, HBO Max and Discovery Plus coming together with our full-on, over the next few years, initiative of having a full basket in traditional, and from free to premium to ad light in digital. And a big advantage in that right now, HBO Max has never been hotter. Quality is what matters. Quality is what Casey and that team is delivering. It's the best team in the business. We're doubling down on that HBO team. They're all committed under contract, and we're going to spend dramatically more this year and next year than we spent last year and the year before.
Just to go on the sports and news for streaming, I guess I'd categorize it as on sports, it's really about experimentation that I'd say and we're going to continue to be disciplined. We have essentially two experiments ongoing, which is one where we bundle sports in this case, Champions League in Brazil and Mexico, into our core entertainment offering at the same price as an acquisition driver, and we are very happy with the results there. And then we got a second one in Europe where we upsell sports to a buy-through tier at a higher price point, and obviously we'll be doing more of that now as we get closer to closing on our BT Sports deal in the UK, which is will be the biggest experiment on that. And so we love the two experiments we have going, and I think we want to see that play out a little bit more to understand better what is the right strategy there. But we're going to stay disciplined and smart as it relates to sports. In news, I'd say it's really more about we see live news as still a critical, healthy, important part of the traditional pay TV ecosystem. And so live news will continue to be exclusively in that service. But that long-form factual programming from CNN in particular, with their award-winning originals and CNN films, that has a natural home and a huge demand that we can satiate now. Initially on Discovery Plus, as we announced this morning, and then eventually sitting firmly within the future product as it comes together. And lastly, on news, we obviously continue to see outside of our kind of core streaming products with CNN.com and the CNN digital services, a lot more opportunities with over 100 million users across the world to continue to experiment with that product and move potentially on ways to find not just ad-supported models, but other models where we can monetize that significant user base that comes to the service.
You can clean start DC, but you still keep
and then
Henry.
Jessica, on the guidance. So just to recap, we adjusted our outlook predominantly for three reasons. The macroeconomic outlook that today is
That's right,
a little less supportive than it was 15 months ago or even in April when we last spoke. The industry dynamics in the streaming space, and then the differences that we see between projections made available to us prior to closing versus what we now view as the legacy Warner Media budget baseline post-close. And to answer your question specifically, that your walk from the 9.5 for this year to the 12 for next year, the math is obviously right. So you are right, $2 to $3 billion of synergy capture, as I said. I also do think that we're going to see some flow through from the course correction measures that we have implemented right after closing that should support the first quarter, second quarter of next year. So if you put that together, the answer is yes. I'm not really assuming any meaningful growth in the underlying growth in the business as usual in those numbers. The main reason is, as I laid out in the outlook for Q3, is the macroeconomic environment. There are so many factors right now. I just don't think it's prudent to guide to a significant underlying improvement here in the core business. That said, we are super excited about the progress we're making on the synergy side. David spoke a little bit about the linear business. I do think that there are further cost opportunities there. So we'll keep monitoring the external factors. We will keep doing the work for the areas that we control and update you as we go along.
Great, thank you.
Great, operator. Let's go to the next question.
Jesus.
Your next question comes
Bank
from
of America's mics don't work, and this dude's
Suisse.
like on overdrive.
Please go ahead.
Thanks so much for taking the question. So, Gunnar, following through on that, the 33 to 50% free cash flow conversion in 2023, what's holding that back from your usual 50 to 60% that you talk about? And does that get cured by 24, or is that long-term goal of 60% something that's going to feather in over a longer period of time? And JB, I'm just curious on what's your confidence level in the ability to increase engagement? It's a big driver, I think, of what you're trying to do. And as that engagement increases and you're able to monetize advertising at a higher and higher level, is the thought that you keep the price point and let that ad dollars flow through to the bottom line, or do you lower your ad-supported tier price point and try to broaden out the service? How are you thinking about pricing on the ad tier, particularly in the United States? Thanks.
Let me start, Doug, with your cash flow question. So, bottom line, the drivers behind this, a third to a half conversion guidance are essentially the same that I laid out for the EBITDA outlook. And then in addition to that, we obviously right now have a number of moving pieces and cross currents in our financials as we move through our restructuring, the cost to achieve for our synergy program. There will definitely be some CapEx requirements, and we'll have to see how the cadence for our content investment pans out. So these are all factors that are going to impact these numbers, especially sort of from a year-over-year basis. But to your point, I don't want to give guidance for 2024 yet, but I'm confident that we'll see continued progress towards that longer-term goal.
And Doug, on the questions on the streaming, on engagement, I'll tell you that I think there's three levers that we think are key and why we are confident in our ability to drive much better engagement. Number one is kind of a brand marketing point, which is obviously HBO and HBO Max has stood for something, which was a very high quality premium scripted, in particular, drama series. They've never executed a real brand campaign to define what the new service is. And as we think about rolling out our new service, certainly we will be coming to market with a big, noisy campaign.
Abdul, are you talking about James Gunn's Suicide Squad or the first one?
With a much, much bigger content offering.
The second Suicide Squad was great.
We think the brand and the marketing component of this is significant. Second is obviously the content proposition will be drastically enhanced as we bring the two services together with a much more complete array of content across all the genres that I talked through earlier. And then third, the product enhancements can't be underestimated. We see this from the HBO Max product today where limitations on search and discovery really limit the amount of content that is surfaced and viewed by users.
It was skank.
And we're confident based on what we've seen from the Discovery Plus side and a much broader use of content and a much longer use of a watch time that we can actually get the combined product to see a much higher engagement level. That's one. On two, on the pricing,
I would unironically like to see a David Ayer cut because that first Suicide Squad movie was so bad. I'd love to see an actual
we'll come to market,
what he wanted
we
to do with it.
Discuss specific pricing yet, but we will certainly have more details for you probably as we go into 2023.
All right, thank you.
Thanks, Doug. Let's move on to the next question, please.
Your next question comes from Ben Swinburne of Morgan Stanley. Please go ahead.
Thanks. Good afternoon. Wanted to ask you about the longer-term outlook for direct-to-consumer, and I know we're going to hear a lot more at your Investor Day, so you might not have a lot of details, but it sounds like you're going to have
Ezra
a bit of a pause here in growing the business as you get everything over to one product and one tech stack. So when we think about that 40 million net adds and the path to $1 billion of EBITDA, should we be thinking about that growth as being really kind of starting, at least in earnest, back half of next year? And so it's kind of 24, 25 when we'll sort of see what this business can do. And then I'm just wondering, David, you guys clearly have a view that sort of the streaming at all cost strategy is flawed. I think there's a lot of probably sympathy for that in the market today.
I just want to see it happen,
2019,
though.
When HBO was
I want to see how long it takes them to respond about Ezra. I'd love to see how they decide that question.
I'm just wondering, when you think about the long-term opportunity here, can you get back to those kind of economics? I know you just laid out a 25 target, but
you can't blacklist your investors.
Did you entertain the idea of really rolling back the strategy more
they'd want to,
substantially,
but
or thinking about reclaiming those historical economics for the business? Thank you.
But actually, let me actually take that both questions because I think they're very related. So we laid out some building blocks for the longer term outlook for D2C. And to answer your question specifically, there are obviously two drivers. One is the revenue growth and the operational gearing from that revenue growth. And I think directionally you're right. As we said, we're going to be a little more cautious regarding marketing, et cetera, before relaunching. And so a lot of that incremental growth is going to kick in sort of after JB has relaunched that product in the summer. The other point, though, is cost savings. And as we said before, D2C has a lot of synergy opportunity. We see savings opportunities and synergy opportunities across the entire cost side of the P&L, and that obviously is going to start kicking in earlier. And I mean, in the very short term, we're all super excited about House of the Dragon. HBO is, as you heard David and JB say, in the middle of the largest marketing campaign ever. So hopefully that's going to be a big helper for the very near term in this quarter. And then to your point about the long-term perspective, again, the $2.5 billion. I don't want to give an additional number here, but you heard JB say what we think is possible to be achieved, $1 billion in 2025, despite the fact that we're still seeing some startup losses in that number, even in 2025 for markets rolled out later. And we do continue to see, even for the combined company, a long-term margin opportunity of north of 20%, and that's on the basis of our combined model now with sort of fully fledged frameworks on the various cost buckets. So we're confident that this is going to be a great addition, an additional platform, and as we said, not being religious about turning the entire company into a support pipeline for D2C, but D2C as one additional platform. So I think this is a great outlook. We're excited about it. We're committed, and we'll implement these plans and keep you posted.
There was some buzz today about HBO Max, and we're going to start doing less series. And
there it is.
Our strategy is to embrace and support and drive the incredible success that HBO Max is having. It's really the culture and the taste of Casey and the team, and the fact that they not only read the scripts, but they fight with all their creatives to make the content and storytelling as strong as possible. It's at a very unique moment. We think it's an extraordinary asset. It's an extraordinary advantage. I've said this before. It's not how much, it's how good. That aligns with us at Discovery as well in the content that we've been doing and the characters and the way that we drive brand. But the majority of the people on Casey's team have been locked up. Casey is here for the next 5 years, and we hope longer. He's truly a unicorn. His ability to relate to talent, to make content better, his leadership, and you see it in what's been coming out of HBO and how it's affecting the culture and the energy and what people are talking about. But we want it to be broader. Casey and the team wants it to be broader. And we're starting to have some real success. We're now going to put in everything that's on Discovery Plus and all that original content, as well as some of the premium content from CNN, and it'll be the home of all of that. And we will, as one company, come behind that, and we think that product is going to be superb. And that is what it's about: curation, it's about quality, it's about how good. And so the center spoke of that is the quality of HBO Max and that team. We've already started creative meetings within the HBO Max team together with, we now meet once a week, all the creatives at the company. That's something that we've initiated with me on the lot in person, in addition to the multiple overall staff meetings. But the creative meetings with everyone together has been really effective and a way to not only talk about storytelling, but talk about how do you share content and how do we help each other with great talent. So very encouraged and very supportive.
And Ben, as you probably can imagine, the number one thing in our view for a successful streaming service as a business is to get churn down and to have a low churn number. At the end of the day, having great but small amount of appointment viewing series, the challenge is people come in and then they go out if there's nothing else. And ultimately, the breadth of the offering matters to get the churn down so that there's something for everyone in the household, everyone in the family. And we've seen it across all our data points where the more people you have in a household using the service, the stickier it is, the lower your churn is, the more viable our business is. And so at the end of the day, putting all the content together was really the only option we saw to making this a viable business. And as David said, I think it's important given some of the noise, but that HBO and the Max originals remain the unequivocal home of the best premium television, and it remains the centerpiece of our combined streaming platform, given the quality that's coming out of Casey and that team.
Oh, and JB, I should have mentioned as well that as part of our projections, that's the part that's going to continue growing. We're spending as much as never before, and we intend to keep growing that spend for HBO content. To be clear.
I appreciate all the color. Thanks, guys.
Thanks, Ben. Operator, let's take the next question.
Your next question comes from Robert Fishman of MoffettNathanson. Please go ahead.
Are they in a wind tunnel?
Hi, good afternoon. I have one for David and one for JB or Gunnar. David, you discussed continuing to sell to third parties. Can you just help us in how you're thinking about HBO's strategy to sell content to Sky going forward in lieu of launching DTC directly in those markets? And then for JB or Gunnar, can you address how do you plan to allocate your future sports costs like the NBA renewal to DTC, or how important the ad light or fast platforms play into your $1 billion EBITDA target or achieving that 20% long-term DTC margin?
Affleck
Thank
was
you.
great.
Great. When in Legacy Discovery, we owned together with Mike Freeze and Malone, all three media. We had 30 production companies, and we would look in awe at Warner Brothers Television as really the greatest and largest and most highest quality production operation, and the incredible names and talent that they have. And so the legacy of Warner is creating great content and selling it. I mean, Les built the big business by carrying all of Warner Brothers content. I've said it before, when we were at NBC, it was must-see TV. Jack Welch, when the entertainment guys left the room, he said it was Warner Brothers TV. A maker. They are a maker and the greatest maker of content. That's the heritage of this company. We want to sell to third parties. It's a very profitable business for us. We think it could be more profitable. There's a lot of money being spent for the best content. We have some of the best of it. And we want to continue to do that, and we're going to do that. In addition, we have a huge library of content. And strategically, we are pivoting to the decision of anything that's important to us, to growing HBO Max, sitting down with Casey, sitting down with JB, going through the data. What's critical to us? We're going to keep that exclusively. What kind of content could be non-exclusive and have no impact on us? Why we want to monetize that to drive economic value. And then there's content that we're not even using right now. So massive amounts of TV and motion picture content that we're not using. So do we use that to just develop our own best of class free platform? Do we sell a lot of that? And that's what we're going to come back to you with.
And on Sky specifically, Robert, we obviously have multiple years left in our existing and important and long-standing relationship with them, and so it's not. We don't have to, deal with that question at this point. Sky, the deal, as we talked about, has another is outside of the 2025 time horizon that we gave you, projections on, and so as we get closer to the end of that deal, we'll certainly come back to you with further thoughts as how we go to market on those three markets.
And then Robert, just to clarify two things. Number one, that any fast activity is not part of the guidance that we laid out earlier. Again, we'll update you as we go along. And then to the point about allocating sports costs, I just want to make one thing clear. So the way we're now segmenting the business is following the structure, how David looks at the business. That informs sort of the segment reporting structure. But importantly, we're also treating these individual segments essentially as individual units, and that means that all the intercompany activity, revenues and costs, are essentially negotiated on an arm's length basis. So from that perspective, you should assume that any content, sports or otherwise, is going to be accounted for at essentially fair third-party terms. You will see this leads to a bigger chunk of eliminations in our consolidated P&L, but I think is the best way to really clearly and fairly show the actual economics of the businesses, and needless to say, is also important from the perspective of our partners in the studio space. It's very important that we account at fair market values and third-party terms.
I was just thinking about
Great.
why
Thank
some
you all.
companies don't that have
Robert.
their own
Operator,
streaming
next question,
service,
please.
why they don't license out
Your
some
next
stuff
question
still.
comes from
And the fact that they
Michael
mentioned that
Morris
is very
of
interesting because there's still
Guggenheim.
money to be made
Please
there.
go ahead.
Thank you, guys. Good afternoon. I'd like to ask one about HBO and the HBO brand. I know you're going to share more with us later in the year, but there's been some press indications that maybe you don't feel like the HBO brand itself is broad enough or doesn't have as much value maybe on a global basis as you would be looking for. So I'm curious if you can share anything about how you feel about that brand and the future of sort of maximizing that. And my second question, maybe for Gunnar, when you were discussing the items that have impacted your projections, you mentioned a couple times change in streaming industry dynamics, I guess, relative to when you initiated the merger. I'm hoping you can expand on that a bit. So I understand that valuations have come in, but maybe could you be more specific on the dynamics that you see now is impacting the industry or the profitability of the business that you didn't see a year ago? Thank you.
Thanks, Michael. Well, first, I think the HBO brand is one of the great crown jewels of the company and represents so much, and how we all got introduced to really what premium television and series were really all about. We're going to look at we continue to look. The data right now is more and more. If you look at how people see HBO Max, more and more people are saying that's the place they go. That's the place that they prefer. It's the place that has the highest quality. That data looks different than it did a year ago. It looks different than it did 6 months ago. So we're talking to consumers and we're evaluating, and we'll let you know when we make a determination.
Also, the HBO brand, no matter what, as David says, being a crown jewel will live on. There's a difference between what the service may eventually be called or not, versus what HBO is. HBO will always be the beacon and the ultimate brand that stands for the best of television quality. So that remains unchanged in any scenario in our mind.
Whether it's in the Topco name or not, and we'll keep you posted as we make a final decision.
Also, they are thinking about
changing
the name.
Mike, on the industry dynamics, look, I think it's clear that over the past 12 months and even more so over the past 6 months, maybe a lot of the viewpoints here have changed, and most importantly, when it comes to industry-wide subscriber growth, top line growth. And obviously, a lot of the cost structuring decisions, specifically for content, sort of, are being made, 18, 24 months in advance. The most important point here for us is sort of the strategic response, as JB laid out, is one that focuses on value and on revenue rather than purely subscriber numbers. And I also think if you take a step back here from a longer term perspective, the way I look at the changes in the industry, I view that actually as additional support for how we have all along been describing our strategy. D2C is one platform in a larger portfolio of assets and in a larger lineup of distribution outlets. We're not going to be religious about driving hard to fuel just one platform. D2C has its space, and Warner Brothers Discovery is uniquely positioned with the enormous surface area with our customers to service them and to tell great stories for decades to come.
Okay, thank you. Let's move on to the next question.
Someone needs to pop off with some flash
questions. From John Hodulik of UBS. Please go ahead.
Great. Thanks, guys, and thanks for all the information this afternoon. First on the content spend, we had you guys down for between 17 and 18 billion on a pro forma basis in cash content spend. And David, on the back of your commentary that you're going to spend dramatically more, can you give us an idea of how that grows over the next? If first of all, if that's in the ballpark, and how that grows over the next 6 years or next few years as you reach those 25 targets, and then on the sub growth, you laid out sort of needing 40 million subs to hit those targets. How do you see that broken down in terms of U.S. versus rest of the world? I mean, I think most of the growth you've been seeing recently has been rest of the world, and you've had some speed bumps here in the U.S. with Amazon and AT&T. But do you expect to be able to reignite U.S. or domestic D2C growth as you guys roll out the new product? Thanks.
Thanks, Mark. Look, we're going to spend significantly more on the HBO Max product. In other areas, we'll spend less because we're not finding an effective return. In the aggregate, we're going to spend more money on content. We're a content company. That's our product. That's what we do. We want the best creatives here at Warner and at HBO and at Warner Brothers Television and across our traditional platforms creating content. And we've worked in the budget that content spend will go up in each year in the years to come. JB?
Yeah, I mean, I think we ultimately are going to be measured in terms of our spend. As David said, we were reprioritizing what we're going to invest in. In terms of the penetration, obviously the U.S. The HBO Max and Discovery Plus products are more penetrated than we are in much of the international markets. So by math, we will see more growth coming from outside the U.S. from inside the U.S. But nonetheless, we do see still a meaningful opportunity to get greater penetration in the U.S., even if the total number is inherently of that 40.
Batman does kill. It just depends on who's writing him.
More to international just because of the size of the opportunity.
But the number on the corner of JB's desk and mine is the break even and the 1 billion. If we do that, I don't really care what the number is. We're not in the business of trying to pick up every sub. We want to make sure we get paid fairly. We have very high quality content. In many markets, we should be paid more because we're providing dramatically better content and more robust content and higher quality content. If the number is 122 and we're making over 1 billion, that is the number for us. We're going to grow subs significantly, but we want to drive profitability and free cash flow.
And then on the one other point that I would want to make on the content spend is to the point that David made, we're ramping up content spend. Both companies have been spending more and have been renting up the cash spend. So that should be viewed as one of the drivers as well for the slightly lower cash conversion also into next year as amortization over time catches up with the higher spend as we grow our business.
Makes sense. Thanks, guys.
Okay, thank you. Next question.
Give it a good one.
Your next question comes from Jason Bazinet of Citigroup.
Good old Jason.
Go ahead.
I just had a very basic question. If you guys penciled out the streaming business, the DTC business, and it was demonstrably better than linear, you'd be jumping in with both
Thanks,
feet,
got
right?
bad
And
mics.
as Swinburne said, I think the market agrees with you that they don't really see that today. And so they understand your sort of path to pursue both linear and DTC. My question is this: do you think that there's something endemic to the DTC business that will always make it worse, like churn or the amount of content you have to put into the app to make it relevant? Or do you think it's something that is potentially transitory, like the pricing is just too low today, and if the industry dynamics change and pricing goes up, it could be, in fact, a business that's as good as linear?
Thanks, Jason. First, I think having both is a gift. This is a fully balanced company. We have our linear and free to air. We're a big maker of content for profit. We have gaming where we take our IP into gaming for profit. We have the motion picture business to gather some of the greatest talent in the world and for profit. And then we have our streaming. So having the amount of free cash flow that we're driving to in order to fund and support thoughtfully the streaming business, which is critical as we transition, is a gift. I do think the business is going to change. There'll be probably over time there'll be repackaging. It's for people to. They'll probably end up being a couple of the best services, which we expect and will drive to be. And they'll be repackaging either by the programmers or by intermediaries like an Apple or a Roku or an Amazon. And the experience to consumers will become easier. And as it becomes easier, some of the economic terms and churn may change. I believe it's that it's underpriced. What has ended up happening is it was a reaction to the capital markets. Let's just go ahead and collapse businesses, overspend on content. People have shown that they were very happy to buy HBO, Showtime, Epix. There's a big group of people in America that love premium television. There's a big group that love a robust bouquet of opportunity. And they're willing to spend a lot of money domestically and outside the U.S., not as much, but they're willing to pay. There was a decision to say, why have them pay a lot? Let's just collapse everything in and spend, and then charge very little. And I think that was supported by this idea, like clicks in the 90s, that subs were going to be this great currency. And so we're going to be very sensible. We're about free cash flow. We got the best library, we think, and the highest quality content. We think we could build a great business, streaming business, to touch everyone, but we're not collapsing businesses on it. And I think sensibility will be that there'll be a lot of people that are willing to pay a lot more for the quality that we have.
Yeah, and maybe just to add to that, just quantitatively, look, I wouldn't judge a business by how it compares to a 40-50% linear business, right? I think that's well understood that that's a high bar. We reiterated earlier that we see 20% plus margin potential for the D2C business. We are assuming moderate price and ARPU increases as JB laid out. Look, at the end of the day, the last thing I would also say is it's not either or. I mean, the strength of our business and our opportunity here is the fact that we can manage these various distribution.
We're mainly here for the HBO Max and DC stuff, but they're not wrong to focus a lot on the Discovery stuff because like the true crime stuff they have in HGTV, tons of people subscribe to that stuff. So merging it all together is the best move, honestly.
We effectively have 4 or 5
I could see value in
cash
keeping
registers.
one separate just to get you double up on subs like Disney does with Hulu, but
and either watch or pay for a piece of content. We have every platform in the ecosystem. And in a world where things are changing and there's a lot of uncertainty and there's a lot of disruption, to me, that's a lot more stable and a lot better than having one cash register.
Yep.
Okay, great.
Thank you.
Thanks, Jason. Appreciate it. And operator, if we could take the last question, we'd appreciate it.
Oh, last question.
Your next
Last chance for Blue Beetle and Flash.
Doug Krutz of Cowen and Co. Please go ahead.
Hey, thanks for getting me on. With the rollout of the combined product next summer, obviously you have 2 separate products now that have pretty different content offerings and pretty different price points. How conceptually do you plan to manage that transition? Are you going to allow people who are subscribed to the legacy services to remain on those services?
Good question.
Are there going to be forced conversions? Can you talk a little bit how you envision that playing out? Thank you.
It's a good question.
Yeah, Doug, we will have a migration plan that will allow obviously some element of, particularly you can imagine the lower price Discovery Plus subscribers for some period of time to grandfather into the new product and migrate them or migrate as many of them as possible up to the new product. And so that is all part of the transition plan to obviously get people, optimize the number of subscribers that we retain, but at the same time, at some point, make sure that the people who are on the service are stepping up at some point in time to the inevitable higher price point than the current Discovery Plus prices that are at today. So there will be a transition plan that maximizes essentially retention of subscribers, but ultimately also gets to the right ARPU and price points over a relatively short period of time.
It's good. They don't want to segregate their audience.
Thank you.
Great. Thanks so much, Doug, and thank you everybody for joining us. And that will conclude our call.
Well, what'd you guys think?
Ladies
We
and
didn't really
gentlemen,
get a
this
lot of
does
info
conclude
there.
your conference call for this afternoon. We would like to thank everyone for your participation and ask that you please disconnect your lines.
Well, there it is. No info about the Flash.
Goodbye.
No info about Blue Beetle. Nothing really concrete about what they're going to be doing with DC going forward, other than they're going to focus on it, but we kind of already knew that. So, yeah. What were you guys looking to see more than anything? I thought for sure. I guess we missed our chance with that one guy who came right out the gate and asked about Batgirl. That was the only guy who would have asked about Blue Beetle or Flash or anything. Like after that, no one even touched that stuff, which I was kind of surprised. Yeah, these investor calls, usually people think they're more like the Disney Plus Day stuff where they actually showed a bunch of trailers and announced stuff. Normally, these investor calls are hella boring. That's honestly probably why a lot of people don't stream them, to be honest with you. I was hoping that this one in particular, given all the information and all the headlines lately about how it's the chaos that's kind of ensuing, that we'd actually get some good info, but we didn't get bad info. I mean, at least they did. We got the news that they are going to combine the services. That's good because, like I said, we really care about the DC stuff, sure, and Game of Thrones, all the good HBO content. But you'd be surprised at how many people subscribe to Disney, or not Disney, but Discovery Plus, just for like the true crime documentaries and HGTV stuff. I mean, that stuff, it pops off in its own right. So just bringing it into the bigger platform, good idea. It's a good move. You're going to get people watching stuff on HBO that never would have watched stuff on HBO because they got grandfathered into getting it from having a Discovery Plus membership. So that's good. I think it was okay. We could have got some more info though. Yeah, that's what that was, a ragu. That's what they were saying. They're gonna make one big platform, and if you're a subscriber to Discovery Plus for an interim period, you'll get all the content, but eventually they're gonna make you bump up your price because obviously HBO is like 3 or 4 times the price. I think Discovery Plus you only have to pay like $5 or $6 a month for. So, and I think HBO is like what 15 or 20. I forget how much I pay for it at this point. Zaslav would have already seen something for Blue Beetle. He's had to have, because they announced it was around the same time the merger was taking place that they announced that they're gonna take that to theaters and not just do HBO. And I have a feeling that if Blue Beetle was on the chopping block at all, it would have got axed along with Batgirl. Like they would have canceled that at the same time. Yeah, and it could be too, the Blue Beetle. I don't know how much they spent on Blue Beetle because the the big problem with Batgirl was that somehow they spent like $90 million on it, and what they were looking at did not reflect a $90 million spend. You know, like the biggest thing I saw was them, like they weren't happy with the costuming more than anything, and it didn't feel like big in scope. Oh, HBO's leaving Holland? I don't know about that. I don't know much about that. Yeah, it looks like it's gonna be HBO plus Discovery Plus for now. That was kind of they didn't really announce when, though. But they are gonna be combining the services. And that's pretty much it. That was, like, the biggest news. There was a lot of Snyderverse talk in here, man. Now, you know they're not gonna talk about the Snyderverse. They got nothing to say about it, unfortunately. I would have liked to have had some information about the Flash, though. Some concrete. They did mention they just kinda breezed by it and said that it's supposedly great. I have heard good things about it being, like, they've said the Flash is good. And if it wasn't good, you know they would have just canceled the thing by now, given all the bad press. I mean, it's gonna be absolutely impossible for them to have Ezra Miller go on a press tour. Like, he can't even promote the movie because everybody's gonna be asking him, like, "So what happened in Hawaii? What do you guys say about Hawaii?" Like, all this, they're not gonna talk about the movie. That's kinda sad part. Like, 'cause for all intents and purposes, it's supposed to be good. Everyone who has seen some of it has said it's good, and, I mean, we got Michael Keaton back as Batman. There's Supergirl is in that. Like, there's a lot of stuff to be excited for in that Flash movie, so then who knows what they're doing with DCEU to begin with. They could be resetting it, who knows? You know, Ben Affleck's gonna be in it too, so I'm excited for that. I don't know how they're gonna promote it, but I'm excited to see what they do with it. That was the craziest thing too. They didn't really mention anything about Aquaman. That's coming up soon. They didn't really. I was surprised at Comic-Con they didn't even mention anything about Aquaman. It was so bizarre. I know someone said that, like, their people are hearing rumors that they wanna recast everybody in the Justice League iteration as it is right now. So a new Batman, a new Superman, a new Wonder Woman, a new Flash, a new Cyborg, but not Jason Momoa. They're gonna keep Jason Momoa. He's gonna be Aquaman, and I just thought when I saw someone read that, there's no credence to that by any means, but it's a funny thought to think that Aquaman would be the last remaining member of the Justice League. You know, Aquaman, who's notoriously always memed on, you know, just talk to fish and all that kind of stuff, but he's the last remaining one. That'd be funny, but I don't know why all the hate for Batfleck. Batfleck's great, man. I love Batfleck. They didn't give him good material, but I love how he portrayed Batman. I mean, I've dude, how could you not love this? Like, look at this. You gonna say you don't like this? This is amazing. He's big and beefy. You gotta love Batfleck. I don't like the movies he was in all that much. They could have been a lot better. What they did with him wasn't that great. But the good stuff in, like, BVS and the good stuff in Justice League, really only in Zack Snyder's Justice League, all of the good stuff that happened in those movies is enough to make me like them. Like, there's bad stuff that they weren't the best, but all the good definitely outweighed the bad in those movies. I agree. They should've. They were just at that time, dude, Warner Brothers has been so mismanaged, like, for the last 10 or so years. They just wanted Marvel's success, but they didn't wanna do any of the work to get there. They just saw that the Avengers made $1 billion, so they made Justice League and hoped that they'd make $1 billion. They could've, if they, put some time and effort and actual thought into this the guiding force of what the DC universe could be for Warner Brothers. It's quite baffling how, like, DC, I was just telling my buddy this, like, DC is home to the most iconic, the most just the best in it's all subjective, but the best superheroes in comic book medium, the most iconic superheroes, and the DC Universe movies are just like a second, they're an afterthought to the general audience. They haven't lived up to just general standards of just good movies half the time. It's kinda bad, man. No, it's not an investing channel, but, I mean, if you can invest in my channel if you want. You can donate to it, that's fine. The investor call is what we did, though. I'm just kinda wrapping it up right now, talking about some of the stuff we got. Did you guys see that they did finally confirm that, Lady Gaga is playing a version of Harley Quinn in Joaquin Phoenix's Joker sequel? That's interesting. I really doubt that people were saying that just because she's in there, it's gonna be a musical. It's not gonna be a musical. It's not gonna be a musical, but they are gonna have a musical number or 2, I imagine. I imagine they're both gonna be in their psychosis. They'll be, like, imagining these musical dance numbers in their head, or there might be a real one, like, maybe if they break out of Arkham and there's a big dance number and they're just going through, killing all the guards there. That could be fun. Yeah, there's no way it'll be a full musical. There's just no way. But a couple good musical numbers for just to set the mood, show how crazy they are, that could work. That could be fun. I would not be interested in it if it was a full musical. I'd obviously watch it because it's a Joker. Like, I would watch that. But I can't get into musicals, man. Yeah, the musical aspects, particularly being inside Gaga's head or Harley's head, would definitely make the most sense. As, like, she's, like, doing her analysis on him, because obviously, Harley's his therapist. She starts imagining these situations in her head as she kinda starts to adapt to his and, kind of be overwhelmed by his psychosis as she goes crazy. And then she sees these musical numbers in her head, that'd be good. Be real good. Dude, the super Michael, all I wanted is some information about a Superman movie or at least some information about this man. Like, we can you just say that you're gonna bring him back to do a movie and just move on about it? Like, just say you're gonna do it. That's all I really need. Yeah, it would be really weird if Harley would have just been some random person, or if Gaga would have been some random person, rather. But, I mean, it could have worked. They could have done whatever they wanted. I was more surprised that they even were bringing in a Harley Quinn in that Joker universe, to be honest, because that it was such a even though it took place in a version of Gotham City and it had a version of the Wayne family, it was so disconnected from what, like, the DC comic book universe is. So I was surprised to see that, 1, they were even gonna make a sequel to it, but 2, they really just dive in and say, "Well, no, we're gonna do a Harley Quinn too." I was kinda surprised. Oh, man, Superman, I mean, back in its heyday, Superman was one of the best franchises. Unfortunately, with Superman Returns, that didn't really catch on, and the Man of Steel didn't catch on globally either, so that was just kind of unfortunate. The Man of Steel is fucking amazing. I love Man of Steel. I'm not so worried about Young Justice. Young Justice, the last season was good. They're gonna do another one, I'm sure. I wouldn't see any reason to be worried about Young Justice or anything. I think so. I think Young Justice is fine, man. The show already got canceled in HBO. HBO themselves brought it back, so I don't think it'd go anywhere. That show is, like, cheap and easy for them to produce, and it has its built-in fans, so it's kind of a no-brainer for them to keep doing Young Justice. I don't think they would just stop. But, I mean, there might be a big delay, and I have no idea when they're gonna work on the next one, but I'm sure. They didn't I didn't read anything that came out too much. They're axing a lot of the main thing they're getting rid of is they're not really getting rid of much, they're just consolidating a lot of roles. 'Cause especially once they merge Discovery, like, fully integrated with HBO, they're just gonna have a lot of redundancy. No, no, I did not. No, I'm not a major investor by any means. I hope Fandom happens this year. There was whispers about it happening. Honestly, though, I was pretty disappointed with the last one. Like, they spent, like, 10 or 20 minutes on, Cam Newton designer hats or something. It was ridiculous. I didn't come here to look at Cam Newton, and I did not come here to look at Cam Newton's hats. And then the other thing, they had Grant Gustin talking about his golden boots in season 9 or 8 of The Flash, whichever one it was. Like, dude, no, I don't need a whole 10-minute segment about this. Like, just come on. Yeah, I did hear that the stock dropped during the call. But I wouldn't be too worried about that. If you're an investor in HBO or Disney, or not Disney, but if you're an investor of HBO, Warner Discovery, dude, honestly, unless you have something great being announced at an investor's earnings call, you're gonna stay like flatlined throughout it, or you're gonna drop a little bit because they just didn't have anything new and exciting to share. This is what it is. Especially with all the recent headlines now, like it's just normal. Oh yeah, I wouldn't be worried about it. Especially if they actually do, once they do merge these two streaming services in particular, and they get that stuff up and running, it's gonna go up substantially because there's gonna be, like I said, you guys don't think it, but there are a lot of Discovery Plus subscribers. It's not the same demographic of the HBO subscribers, and that's the point, and that's the good thing for them. Because they're, like I said, they're gonna be getting people who have never had a desire to have HBO. They're gonna have it now. So they're gonna get a lot of cross-pollination from this, and vice versa. Like, yeah, tons of people who have HBO are now gonna have access to Discovery Plus. It's gonna be, it's gonna be good. As long as the app and the interface that they create functions well, and it's easy to use, and the content isn't just thrown everywhere, and it's not confusing for people who have to, like, who were just Discovery Plus members, but now they have to use HBO Max or this new app. As long as they properly redirect these services so that it's very easy for consumers and not confusing, like HBO was. Like, when they were promoting HBO Max, it was just so confusing because of HBO Go, HBO Now, and then you got HBO Max, and it's like, well, what is it? People, when HBO Max came out, regular HBO subscribers had no idea that they, like, had access to HBO Max now. Like, they didn't even know what it was. So as long as they make that transition a little bit better and more obvious for people. Oh, the thing is about the estimated growth rate of 30% subs per year, at some point, you run out of potential subscribers. So I thought it was more interesting hearing them talk about, like, subscribers is not their end goal, and they actually acknowledge the fact that there you can only have so many of them. So it's gonna be good when they first merge these companies because they are gonna, granted, it's gonna be kind of a false inflation of subscriber counts because they're merging services. Yeah, exactly. Like, Netflix's whole model was built around, at least as far as their shareholders were concerned, and what they always pushed to their shareholders was, "Look at how many subs we have. Our subs are this, that, and the other. It's all this infinite growth." That's just not the case. Like, eventually, you're gonna tap the market. There's not enough people out there to consistently bump up your sub numbers. It's impossible. HBO does have a lot more growth potential for sure, especially with the Discovery Plus merger. They're gonna have a lot more eyes on it than they ever, not than they ever did before, but more than they've had at one particular time. There'll be a big influx. I don't think we'll ever see a release the Air cut, unfortunately. I would love to see it. The only thing is the Air cut, the Air cut that David Ayer would actually like to make truly does not exist, because his original cut of that Suicide Squad movie does exist. But after the fact, after the movie was released, he came out and said that he wishes that he would have completely restructured the movie and not had Enchantress be the villain, and would have had more Joker in it, and would have had it focused more on Harley and Joker. So that is what I consider to be the true Air cut. And unfortunately, he didn't shoot that movie. So I'd love to see it, but hell, unfortunately, that version just does not exist. But yeah, I mean, overall, I thought the call was okay. I'm glad they are combining the services. And I think I'm interested when that's gonna happen more so than anything. But we'll just have to see. I don't know. Oh, yeah, I know. I was surprised that the stream popped off for this. I was surprised there was as much interest in the stream, like this particular, the HBO WB Discovery earnings call in general, I was surprised that it's possible. It's possible people just looking up just where the stock is right now or seeing the channel. But even throughout the stream when we first started, there was like I think we peaked out around like 6,000 or some views, which is like I did not think there would be that many people interested in just the earnings call bit of it in general because they're usually very boring. Yeah, yeah, they're just for the investors. Like, and that's really all that anyone. No one want like you'll be hard pressed to find anybody like in my position streaming earnings calls because just no one really cares. Like unless you're an investor, no one really cares. I just thought that with this one, from the entertainment standpoint of things, and just all the headlines that are going around right now, I'm interested in what they're gonna say. So I thought might as well stream it in case something actually exciting happens, but nevertheless, nothing super exciting. But complete reboot of DC? I don't know. I don't think they're going to do a complete reboot. Honestly, I think they'll probably adapt more of the Fox X-Men mentality, and that they just didn't really care about continuity all that much. So like they'll just like James Bond too, right? Like they'll just make if they recast Ben Affleck or if they recast Batman, Ben Affleck or Michael Keaton, who knows which one it even is going to be at this point, but they'll just make a new one and they'll just put it in there. Kind of what I think. I don't know. They're in a really awkward position with the DCEU because of how many people do like the Snyder stuff that was set up, and then Wonder Woman was successful, and then Aquaman is successful, like on their own. So, and then if Flash comes out and it's also successful on its own, which is its own kind of problem because of the Ezra Miller situation, but just the fact that the characters that Zack Snyder set up in his Snyderverse movies have been successful in their own standalone films, it makes it a lot harder to just recast everything or reboot everything. So without having something like in universe reset, like in the Flash movie, if there is some sort of soft reboot that occurs because of something that Barry Allen does, then that'd be the only way they could really do it. But because you still kind of need to keep Jason Momoa as Aquaman, Gal Gadot as Wonder Woman, at least for one more movie, because their movies were successful. And so it's just kind of hard. No, Ben Affleck will be the only Batman of the. I really don't think, as much as I would love to see Ben Affleck come back, and I would love nothing more than for Ben Affleck to make that Ben Affleck directed, written by Batman movie of his, where he was going to go toe to toe with Deathstroke, Joe Manganiello's Deathstroke. Like, dude, I love Deathstroke. I was so excited to see that movie. And then Ben Affleck was like, they had the whole costume design for Deathstroke. They were teasing it. I forget his name, but one of the lead directors for DC's animation team said that he read the script for Ben Affleck's Batman movie, and he said it was just blanketly one of the best Batman scripts he's ever read. So like I was super hyped for that. And of course it never got made. Warner Brothers used to be part of it. They split off the visual stock. This one of their this is their. They had one other earnings call in Q1, and that was pretty much it. Yeah, it was Jay Olivia. That's exactly who it was. B Zombie. Yeah, he said it was him. He read the script, and he said it was one of the best Batman scripts he ever read. Just Batman. I think he either said Batman scripts or just Batman stories, and I was like, that's cool. Like I mean, it's always subjective. Everyone has their own opinions and everything, but like when I like a lot of Jay Olivia's work that he did with DC animated stuff, so he's obviously written for the Batman character or at least directed in the animations. Something that has to do with Batman, so he's someone who's of the know. So if he says like, someone, he reads it, he says that it was a really good Batman story, I believe that more than just, some random person telling me it's a good Batman story. You know, this guy that was at least part of DC in some capacity, so he's obviously read a lot of Batman stuff. So damn, I was excited for that. Yeah, I don't think in the end though, I don't really think Ben Affleck's Batman's gonna be showing up. So to my great dismay, I mean, I got the BVS Batman hot toy. Just got my Nightmare Batman 2-pack hot toys in. Like absolutely love Ben Affleck's Batman. So you're preaching to the choir if you want to see Ben Affleck back as Batman, but I just don't think it's gonna happen. But all right, guys, I think we're winding down here. I appreciate you guys for watching the stream. Go ahead and like and subscribe. You know, if you're here, I'll obviously do more stuff like this in the future, and especially since I guess I was maybe the only person doing the Warner Brothers earnings call stream. I'll definitely be I'll be keeping a close eye with, you know, I'll have great interest on these future ones because they have some good stuff coming. And I am just, as a fan, fundamentally curious as to what they're going to be doing with the Warner Discovery merger as far as the streaming services are concerned. Really need some information on what they're doing with DC. I would love for them just to come out and have a more Disney Plus Day investors call that they had. So I'm hoping the one they've talked about it a couple times, the merger that happened. They promoted that there's going to be another one towards the end of the year that they're going to have more information for. So I'm hoping when that one comes around, we'll have a lot more solidified announcements and plans for things that are actually to come with like movies and the TV shows, what they're doing with HBO, and just, you know, I'm sure by that one we will 100% know if they're going to be changing the name from HBO Max to Warner Plus or Warner Max, or I kind of hate the names just adding plus at the end because everybody does it. Like you have Paramount Plus, Apple Plus, all just plus, but that's also the kind of reason you got to do it, in my opinion. Like everyone does it. Everyone just, when you look at Warner Plus or Warner Bros. Plus, you know exactly what that is because that plus, it's a streaming service. Oh, okay, yeah. I would love to see a Final Crisis film. Oh, is a Disney one coming up too? That's interesting. If I have time for it, I might just hop on it and do it then. Might as well. That's hopefully it's a little bit more interesting. Disney's in a kind of an interesting position too, because Bob Chapek is I can't remember if it's coming up at the end of the year or they just recently decided to re-up his contract for just 1 year though. It was one of the two. I can't remember which it was, and not everybody's very happy about the Bob Chapek situation, so I don't know what's going on with that. August 10th. Okay, I'll try to remember that. I will try to remember that. Thanks. Thanks, Miles. Ubi, I don't know. DC, well, we know what's next for HBO Max in some capacity. They're going to be integrating the Discovery Plus content into HBO Max. We know that much. DC didn't really get any information on, unfortunately. To be fair, it was just information they already said. Like he just came out and Zaslav said that they are focusing on just making sure that they're prioritizing DC and they're focusing on quality content in relation to DC. And that's pretty much all he said. No information about upcoming projects, nothing like that. So, but yeah, we'll just have to wait and see. Guys, you might see me back here if I have time, since there is a Disney Plus earnings call on the 10th, I guess. I might stream that too. Depends on if there is anything really interesting going on, and if I have time to do it, I'll do that. But like I said, I'm going to take off here. Oh, thanks, Miles. Thanks. I appreciate it. Thanks for the info about the Disney Plus one too. I'll watch that. You know what, dude? I don't know what's gonna happen with Peacemaker, but they are making a Peacemaker season 2. So James Gunn said that. So they didn't say anything about it though. So I definitely nothing to worry about as far as Peacemaker is concerned. That show was great for them. It became the #1 streaming show in the world when it was the main show on everywhere. So yeah, they're not doing anything for that. Yeah, dude, the market will be fine. I definitely wouldn't be if you're an investor in Warner Discovery, dude, you're fine. Like honestly, if anything, because of the drop, now it's probably do not take financial advice from me. But if anything, because it went down a little bit, it'd be cheaper for you to buy in, and it's just going to go up later. So yeah, you buy the dip exactly. Like this would actually be a good time to buy because it's only going to get better for them once these two streaming services are combined, especially if they can get their shit together with DC and start making movies on a more consistent basis that are at least remotely close to the quality of Marvel. Because I mean, Marvel estimates about $1 billion per movie. So if DC could even have a fraction of that success, Warner Discovery is going to be doing great, like really good. Like, yeah, they definitely have some long term growth potential, no doubt, absolutely. But yeah, I'm gonna take off, guys. Thanks for watching again. Go ahead and like the stream, subscribe to the channel. I always have more stuff coming out here, especially more recently. So, but it was good having you guys here, good chatting. But I'll see you guys in the next video.